Greetings. Welcome back to Financial Accounting and Accounting Analysis. Dr. Scott Dell at your service. This session, Module 1C, will be talking about GAAP, Ifrs, and SOX. GAAP means generally accepted accounting principles. Those are the principles and standards that determine how we record things here in the US, also known as US GAAP. We'll also talk about IFRS, International Financial Reporting Standards. Standards that are used around the globe. Now, they're not always consistent. Every country can have different versions of IFRS, but the IFRS standards are fairly closely related. And finally, we get into the SOX, the Sarbanes-Oxley Act of 2002, that came about as a way of addressing fraud and trying to prevent it and restore some faith in the financial markets at that time. You might have heard of folks like Enron or WorldCom or Tyco. They instilled fear in a lot of folks saying, well, a lot of people are stealing. How can we believe any of the numbers that are coming out of here? So we're going to talk about all three of these categories and areas to give you additional insights into financial statement preparation and the tools that accountants use to take care of that. So let's talk about what the heck is GAAP. Well, we mentioned it already, that generally accepted accounting principles. These are the overriding ideas that determine how we record information. The key is communication. We're communicating financial information to knowledgeable users. We're not saying that a third grader should be able to read a financial statement, but we are saying somebody with a little bit of financial savvy that might have had some accounting in the course, or might be an investor, or might be an analyst, or once you get your MBA, you would be a knowledgeable user of financial statements and could and would have a basic understanding. What falls under GAAP? Well, they're the rules of when, how, and how much to record transactions for. I'll have a few questions for you in a few minutes to get you to think about that. There are standards on how information are presented. Yes, we have a balance sheet. Yes, we have an income statement. And yes, there are rules to follow in the preparation and presentation. And then the procedures as we record transactions on an ongoing basis. If we buy a business, how do we do it? If we invest in stock, how do we do it? If we are using a variety of inventory methods, why are they different and how can we use them? And what happens if we decide to change? We might want to change to a different standard. Can we do that? And then we'll touch upon IFRS, International Financial Reporting Standards, which is similar but different to US GAAP. So that's where we're headed on all this. So let me ask you the question. Company owns Apple stock. At what value will that stock show on the balance sheet? Well, you're going to have the price you paid for it. You're going to have the market price today. You might have an appraiser come in and say, here's what I think it's really worth. Maybe lower of cost or market. What are we going to determine? Where are we going to put that and say, what's the value? If we look at that, we say, you know what? Oh, there's that it depends answer again. And the bottom line is the answer is it depends, because it can be recorded typically two ways. And I'll share with you those two ways. The it depends is really the answer we're looking for, because typically if you have a trading security, if you're going to be selling it next week or the week after, it's probably market value. But if you are buying it as an investment, holding on to it for 2 years, 3 years with no intention, and I did say intention, you mean my intentions determine how these things throw up? That's how they show up on the financials. So if I intend to hold it for 2 or 3 years, it's going to be historical cost. But then again, what happens if I lost money? We get this thing called lower of cost or market. And if the market rate goes down, do we want to overstate them on the balance sheet where they show up as an asset? Probably not. So all of these may come into play depending on your intentions of how to handle that. How about a car dealership? You're going to go buy a car. Well, if you can get one, good luck these days. So you want a new car. When does the car dealership record the sale? Well, here are some answers. And go ahead and text me what the answer you think should be, and we'll discuss in a minute what the reality is. But you can drive the car, you test drive it and say, I like this car. I want to buy it. Can you record the sale then? How about you negotiate a price? You go back and forth, and the sales rep takes it to the sales manager. You initial it, and they initial it. And they say, "Great, congratulations! You're now the owner of a nice new car." Or is it when you sign the contract or the agreement to purchase and you give a deposit? Here's my $500 deposit on this vehicle. I do have to get financing. Ideally, you came in with financing or you're paying cash. But if you're financing, maybe you go through F&I, finance and insurance. I used to sell cars, among other things. When you're approved for financing and sign the paperwork and you write the check to pay in full, do you own the car? Or when you come to pick it up and sign for the title? Or do you wait until the loan's paid off? Because really the bank owns the car in essence. Or are you never able to record the sale as a dealership? Or it depends. And yes, the proper answer is probably going to be it depends. But there's another answer that is more typical of when the car is yours, when the ownership changes hands, when you can record it. So think about that for a minute. Go ahead, send me a text with your preliminary answer, A, B, C, D, E, or F. We know it's not never. And yes, it depends, but we're going to go with one of the answers from one of the above. So let's think about that. Well, the reality is when the title is yours, that's when you own it. All that other stuff is fluff. At any time, financing falls through. Okay, not your car. You might have given them a deposit. You get your deposit back. Thank you very much. Or you sign all the paperwork, you write them the check, you paid in full, but you haven't accepted delivery. You walk in there and they had a hailstorm. And you say, "I'm not taking this car." And they need to give you your money back. And by the way, you do not get a 3-day right of return. That's only if they sell you the car at a show or at your door. They come door knocking, door-to-door sales, or at a trade show. When you're on their place of business and you buy a car, congratulations, you own the car. On a contract, you are obligated to meet the performance of the contract unless the car gets totaled and it can't be executed. All right. Good luck getting a PlayStation. That's worse than getting a car these days. You buy a PlayStation, a nice model, PS5, 5-disc, with the Spider-Man and the dual controller and some other bells and whistles. At the time, you bought it directly from Sony, not from Walmart, not from Best Buy. You got it from Sony, and thank you very much. That's the only place I could have gotten it. Do you record it as 0 until they cash your check? Do you record $8.90? I'm sorry. Do they record as $8.99 sale? $8.99 plus tax. Is that tax money theirs? $8.99 plus tax less shipping costs. $8.99 less the cost of goods sold. Oh yeah, they have costs associated with manufacturing that thing. Or $8.99 less the anticipated warranty expense and cost of goods sold. They'd have to record a warranty expense at the time of the sale. If you recall the good old days, most of you are old enough to remember the Xbox came out and was a nightmare because power supplies kept burning out. Microsoft had to honor the warranty. They were anticipating 5%, 10%, maybe in returns or in warranty service. But at that point, almost 100% of the Xboxes needed to be shipped in, repaired, and shipped out with new power supplies. They didn't budget for that. They partially budgeted. So the obvious answer is going to be either it depends, because there's some room for interpretation. But the bottom line is the taxes are not theirs, but the sales is going to be recorded as the dollar what they sold, less the cost of goods sold, less the warranty expense. That's the net of what they're going to pull in. So GAAP determines how we record these kind of things. And these are questions that need to be answered. When do we recognize revenue? When do we recognize expenses? When do we match things? So who makes GAAP? Let's take a walk through and take a look at the arbiters of GAAP. So we're going to start with Congress. They're the ultimate arbiter. They're the folks that say, hey, here's what we need to see. We're going to protect the public. We're going to take care of the public good. And that's the folks that ultimately are responsible. But they have actually delegated to the Securities and Exchange Commission. Market crash, 29, 33, they have the SEC Act of 33, and in 34, they created the Securities and Exchange Commission, the SEC. They're the folks that oversee the markets, protect the investors, stock markets, investment advisors, the actual securities themselves. Anybody who's publicly traded has to file on EDGAR, that we used before. So those are the tools, and the SEC is the environment that is responsible for protecting the public. They have 5 commissioners or 4,500 staff. Some say that's not enough. Some say it's too many. But the idea is they're here to protect you and I as investors. But the ultimate responsibility of GAAP falls to the Financial Accounting Standards Board, also known as the FASB. There were rules and regulations prior to 1973, but the FASB was created as an independent nonprofit to replace the Accounting Principles Board, which ran from 59 to 73. So the Accounting Principle Board, which fell under the AICPA, was not unbiased, was not an independent body, because they had CPAs there. CPA professionals belong to the AICPA. I belong to the AICPA. I am a CPA. But the idea here is, well, we need some public representation on this board. And when the funding is not going to come from the AICPA, it's going to come from a separate group that handles the funding, overseeing so people can't be bought, basically. So the Financial Accounting Standards Board is responsible, although it can be overridden by the SEC and can be overridden by Congress, but basically it has been delegated to prepare GAAP to the FASB. So let's look at a sampler of some of the pronouncements that the FASB has issued recently. This is not all of them in the past couple of years, but I picked a couple that, okay, troubled debt restructuring, credit losses. The Accounting Standards Committee, ASC 326, they had 4 different issues of requirements, and there's a whole process. They go up for review, they create it, they review it, get a public response, and then they implement it and have a due date. Derivatives and hedging. You've heard some things about derivatives and financial instruments. The 2 I want to emphasize here, though, and big ones that are recent, that are having significant impact on financial statements, especially if you're trying to compare from 2015 statements to 2020 or 2022 statements. Accounting for leases, which I actually mentioned a little bit about that when we talked about Walmart, that not only can they just put on the income statement, but they also have to make an asset and a liability associated with the lease. I mean, if you were buying a business, would you want to know if you had 100 leased vehicles in obligation for the next 3 years? Or if you were in a 10-year lease in a building and you were stuck in the building, you bought the business, and I'm going to take them over and move them, close this office, but you're still in a 10-year lease. You'd want to know that when you bought something. Accountants want to share that information and demonstrate. So leases is kind of, lease recognition is pretty important stuff, ASC 842. And RevRec, also known as revenue recognition. Notice 18, 16, 16, 16, 14, 15. There's a whole bunch of rules and regulations. Because when do you record revenue? I've got a 5-year contract with the government, and they're going to pay me over 5 years, or they're going to pay me all up front, or they're going to pay me all at the end. When can I record that revenue? Is it when they pay me? Well, the short answer is no. The long answer is, well, we got to determine and what rules fall under, which again is why accountant makes the big bucks, because they have to look at, read all these statements, interpret, make decisions, and show that, okay, we can justify based on GAAP how we're evaluating things and how we're presenting things. A short detour on IFRS or Ifrs, International Financial Reporting Standards. Well, the FASB responsible for US GAAP, the same way the International Accounting Standards Board is responsible for Ifrs. Now, out of Norwalk, Connecticut, I think England is where the IFRS is based, but they have an office in Norwalk, Connecticut, as does the FASB, which is based in Norwalk, Connecticut, up in New England. So they are trying to work closer and closer, and the standards are getting closer and closer. So whenever GAAP is making changes, they're talking to the Ifrs folks. When Ifrs is making changes, they talk to the FASB folks, and they're trying to bridge that gap. But there are differences. There are 120 countries that use IFRS, include Japan, Canada, UK, the European Union. But many countries have their own variations. They have their own interpretations. But a couple of things that are interesting is that Ifrs overall is more concept-oriented, more fair market value-oriented, where GAAP tends to be more historical cost. And Ifrs will tend to yield higher net income than GAAP. GAAP tends to be more rule-based, more historical cost-oriented, as I just mentioned. So historical cost versus market. Well, if you increase the value of something on the asset side, if this balance sheet, there's some profits to be recognized by that increase and under comprehensive income. Even if you haven't sold it yet, the asset went up in value. All of a sudden, you've got increased equity. And GAAP is conservative. We don't want to overstate anything. So they're going to use a lot of historical cost-based numbers. We're going to go into a lot more detail in the different sections in the future to do analysis to determine how we fit in with GAAP. Both GAAP and IFRS, more similarities and differences. They both have balance sheets. They both have assets, liabilities, and equity. They both have revenues and expenses. Both have inventory. Although it's interesting, IFRS does not allow something called LIFO, last in, first out inventory. They do first in, first out. They do average cost, which is part of GAAP, but they don't do LIFO, which is also part of GAAP, or LIFO reserves. Let's talk about Sarbanes-Oxley. We're not talking about the Red Sox. I'm a native Bostonian myself, and those are official Boston Red Sox. But the Sarbanes-Oxley Act of 2002, investors were not real confident in things that were going on in the financial world. There was a time when Waste Management, Enron, WorldCom, Tyco, these were folks that were playing games with financials. And the numbers were getting kind of scary. And very high numbers were being distorted. And then investors lost lots of money when they realized this ain't true. But it did not prevent other frauds. Health South, I actually knew the CFO of Health South. He went to jail for 3 years, and now he's talking to a lot of folks about what goes on. It was out of Alabama. We have an office of Health South here in Florence, actually. Freddie Mac, AIG, Lehman Brothers, you might have heard some of those scandals going on. Those are all post-2003. But Sarbanes had a bunch of rules that did improve a bunch of things. What kind of rules were involved? Well, they made the CEO and CFO, Chief Executive Officer and Chief Financial Officer, part of the C-suite, the chief suite, sign off and take responsibility. They're signing off that they read the stuff. No longer can the president or CEO of Enron say, oh, my accountants did that. I had nothing to do with it. CEO is taking responsibility and will pay fines or do jail time if there are material things that are discovered. It also required management and auditors to assess something called internal controls. This saved a lot of auditor jobs, by the way. Auditors have to go in and do that opinion letter on the books, qualified or unqualified. And that unqualified is what we want, but they also found that evaluating internal controls per SOX was a nice revenue stream, a revenue source, and actually pretty valuable service to provide to the client to serve. It also created the Public Company Accounting Oversight Board, the PCAOB, which oversees auditing firms. The accounting firms aren't immune to challenges, aren't immune to deficiencies, aren't immune to poor work. And they come in and say, well, we're going to check out the work of the auditors to make sure the auditors are doing good stuff. And they also want to validate auditor independence as that goes. If you are a CPA firm, like a big four CPA firm, which is 4 largest CPA firms in the world, and you came and installed the financial systems, you have a consulting division that does financial stuff, and then you went to audit those financial systems, you think you're going to talk about, well, we really screwed up this installation, the numbers we can't trust. That's a little bit of a conflict of interest. So SOX kicked in and helped out with that. It also added financial reporting requirements, including off-balance sheet transactions. Enron was doing a lot of off-balance sheet stuff. And by the way, we talked about lease recognition. That's stuff that's off the balance sheet. It's on the income statement. Well, now it's going to be back on the balance sheet. That's why we record an asset and a liability associated with those leases. So some big numbers. It also assigned criminal penalties for altering documents. So if somebody internally lied, it changed things, and again, generated fraud, there's some actual criminal penalties assigned. Finally, whistleblower protections. So if you have somebody internal go into the SEC and say, by the way, these guys are messing with the books, not only will the whistleblower be protected, they actually get a percentage. It's actually an interesting business. It also does label you as a whistleblower, and may have a hard time getting hired, which is why they financially protect you somewhat and give you some percentages back with that. They also required companies to have an audit committee with some knowledgeable people on that committee. Used to be an audit committee says, yeah, I'm a lawyer. Great. Okay. I'm in marketing. Cool. Nothing wrong with being a lawyer in marketing, but if you need to understand how an audit is handled and hire an auditor and interpret what an auditor has to say when they come with their management letter, how to improve things, you want somebody with some audit savvy or an accounting savvy showing up on this committee. So those are some of the things that go with that. That's our overview of SOX, Ifrs, and Gaap. Hopefully you picked up some insights, some better understanding, some of the concepts, and we'll go onward and upward. We're also going to, in our next module, talk about some data analytics. Yeah, back to some number crunching and analysis, but that's a lot of what accounting does for us. So thank you for your participation. Glad you could be here. Hope you enjoyed and learned a lot. Dr. Scott at your service. We'll look forward to seeing you again soon.